and certainly we had seen Asian markets quite markedly underperforming both the US and to an extent European markets in the first half of this year. There's a degree of catch-up now being played there, and I think that's probably a trade which is going to continue going through to the first quarter, particularly as we begin to see those infection rates for COVID beginning to tail off.
You know, in your fixed income strategies for 2021, you're saying Asian opportunities should be the focus, but China is in the best spot at a time when we're talking about SOE defaults rise, and that's spilling over into the private sector as well. We just spoke about the RUI Group defaulting on its second bond payment. How does that set into your view?
Well, don't forget that the Chinese bond market is not monolithic, so it's very much a question of the credits that you choose to have exposure to and the analysis that you do in order to support the creditworthiness of those issuers. So that remains a critical factor in any fixed income portfolio that you're putting together. And that's not going to change anytime soon. So you're always going to be looking for those issuers which have good, strong cash flows, good, strong covenants, and a good, strong track record in repaying bonds on maturity dates. So avoiding the other stuff is obviously going to be critical, and that's something that we're continuing to do.
But are you worried about the situation? How closely are you monitoring what's happening in China in the fixed income markets and these bond defaults?
Very closely. I mean, we don't have any exposure to those troubled issuers, and those are the companies that obviously one wants to avoid at all costs. But to be fair, the writing has been on the wall for a lot of these things for some time. So it's not exactly coming out of a blue sky. You can see the balance sheet stress that exists for some of those issuers. And as I say, avoiding those is obviously extremely prudent.